product. And we can have a renovation product. We have about 20 to 22 different ones that we can do for FHA, which typically that's the most known one with Streamline and a full-blown program. Whereas a Streamline means up to $35,000 or non-structural, which means that if there's no structure damage, you can do the Streamline. If there's structure damage that you're repairing, you know, if it's a $10,000 addition of something being done like a roof, if the roof is leaking, that's fine. If the trusses are damaged to the roof leak, then that becomes a full-blown FHA renovation, and we'll have to have those product lines, even if it's under $10,000, even if it's only $10,000. We have the VA Streamline renovation. We have conventional renovations. There's even a USDA renovation type loan. It's also limited, but we can do that as well. So we've got just about any loan that needs to be done.
What are some examples that you'd use a streamlined renovation loan for with any of those?
A good example would be, say, if you want to move in the house, there's two things. Say if the kitchen makes the house unfinanceable because there's no sink, there's no cabinets, there's nothing there. There's nothing structural to be done. So you can do a streamlined renovation, whether it's FHA or conventional. Okay, you have to go out and get your bids and so forth. And what will happen is we will be escrowing after closing, escrowing the money in the loan so that when they do steps in the work, we can send them their money, the contractors. And the appraisal that's done at that particular time will be subject to the projects being done, like say the kitchen being done and that sort of thing. The other thing, which is very similar if you wanted to have a streamline, is if you just don't like the cabinets. Same sort of thing. You've got to get bids to replace the cabinets. It is financeable, but you want it all in one loan. So that's another reason for doing streamline. Or any renovation loan is you either want to make the house financeable so it can be purchased, or you want to take care of some things that you want done to the house and anything in between.
Okay. What about manufactured homes?
We do those.
And there's all sorts of different breeds to that. I mean, we've got houses that are on a permanent foundation, houses that have skirting around them. Mm-hmm. Some fit one thing, some fit another. What are the things to look for?
There's a lot going on with manufactured housing. There's two basic types of manufactured housing, and then there's sub of the two basic types. The two basic types are modular, which are manufactured housing, mm-hmm. and then you've got what they truly call manufactured housing. A modular house is made in a factory.
Yes. Just
like a manufactured double wide home is, which is a common nomenclature. But they are made to higher standards, basically. So they actually will compare them when they do an appraisal to site-built homes. Sometimes they're even better because all the wood and so forth is made in a factory and it's put together. But instead of having, which most manufactured homes have, they don't have a steel chassis. Mm-hmm. So they come in and they're just like a regular house basically, but they come in on trailers, but they're not manufactured onto a trailer. Whereas a typical manufactured home, which can be a double wide and or a single wide, they have a chassis that's metal with them, is what happens. And those are different parameters. One, rates are typically going to be a little higher, but you get a big bang for the buck. And they're actually going to be appraised on a manufactured housing home. The only one that doesn't differentiate between the two is a VA loan. They have a VA appraisal form that they use, so they don't care if it's a manufactured home or not. They have it noted, but they don't have certain stipulations that some of the other loans have.
Oh, interesting.
Oh, it can be. And then there's something called an on-frame modular, which for years it hasn't gone over well. But some of the manufacturers, to save money, they would use everything for a manufactured double wide home, but make it beefed up to be above the manufactured home standard guidelines. But that has a problem with some of the not the lenders, but the GSEs, the government service entities that buy the loans that the lenders close, because they can't determine what it is. So they've shied more away from that these days because they didn't know if it was going to be Fannie Mae, which everybody's heard of Fannie Mae, it's a government service entities, they've been in the news, or Freddie Mac, which is another one, and those two have different guidelines, believe it or not. So the manufactured home, you need to be very aware of it. And so let's go back to the true manufactured home again, double wide, single wide. One, it's got to be deeded to the property as real estate. It can't be a chattel. And what a chattel is, it means it's not deeded to the property. You have real estate and then you have personal property. So it have to be converted to real estate before doing a home loan on it.
And so the one that's not tied to the real estate, you're going to have a title with the DMV.
You will have a title
Yes.
DMV with all of them. I'm going to.
But when you transfer it to real estate, the title doesn't go away with the DMV?
No, it gets
Okay.
disposed of as real estate, but it's still
Okay.
a DMV.
Okay.
And that's what has to be done. So when something's converted to real estate, say manufactured home, that title's got to be disposed of as real estate at DMV, and it stays with them as that record. And the reason that does it is so that there are no liens against it, because DMV is a private record and the county record for real estate is public. I had this happen recently on a single wise, because we'll even do single wise, but it's different. But I had 2 counties in Southwest Virginia, and I had a realtor that had listed the house in Southwest Virginia, but I had a buyer's agent I dealt with. And they were in different counties, so the one that was in the county had done single wides in their county. And so I asked him, I said, is it disposed of as real estate at the DMV? She says, well, they do that at closing. Well, I've done enough to know that that's not done at closing. It has to be done sooner or later, because I've looked and I researched all my deals. I looked at the property that's being sold, and it didn't have a improvement or a house on it or something declared as real estate. It just had land.
Mm-hmm.
So I actually called this county, and this county says, well, we never, ever dispose of single wise as real estate. They're always chattels. I said, that's interesting, because I knew the county next door did, but I didn't know the process. And I called the county next door, and they said, yeah, we do that, but before we'll even declare them as real estate, we want to see the title disposed of as real estate at DMV. Something not required by counties that do double wides, because they know they can't move them.
Mm-hmm.
And she said, if we get 10, we might do one, because we want them to be good condition. And these 2 knew each other, but the 2 counties were different.
Wow.
So the realtor had listed the single wide for sale, saying it could be FHA approved, and it couldn't be, because it was not going to be it's not going to be disposed of as real estate at DMV, and it was not going to be put on the county as an improvement. So I got those 2 talking to see if they could figure it out and maybe help this person down the road. But that particular deal was not going to go forward, because I researched the property before they tried to make an offer on it. And I will do that with every loan. If somebody's buying a house, I want to research that property. I want to see if it's a flip. And what a flip means that somebody's bought it and they're selling it pretty quickly. It can be within a year, but they're easy things with a year flip. But if you're doing FHA, I had one come to me the other day. I could take it USDA, but I couldn't go FHA because the flipper, the person that bought it to sell it, bought it in December of 2022. And FHA won't even do a loan until it has been in their possession for 3 months.
Was that because the person that bought it to flip got an FHA loan?
No. They paid cash.
Okay.
But they had paid for it.
So it's still that time frame.
Right. It's still, if somebody buys a house to sell, and there are some caveats, but if they buy a house to sell, it's called a flip within typically the year. But most of them are okay. But with FHA, you cannot put a contract on that house with an FHA loan to buy it until after 90 days. And I've actually told people that came to me, like, say, 2 weeks before close, I said, you can't put a contract on it until after it's actually 90 days. And then if they try to make too much money on it, within 180 days, they've got to get a second appraisal.
Wow.
Which is pretty interesting on that aspect. And what that is like, say, if somebody paid $100,000 for a house, and then they sold it for $200,000, between the 90 and 180 days, there's going to have to be a second appraisal that FHA requires. And the buyer can't pay for that. So somebody's got to pay for it.
That's something that's got to be negotiated. And
It's
by
gotta
you
be.
doing some due diligence, you're helping the realtors. And if you do that before we make an offer, then we can know that there's going to have to be 2, and we can make sure that that's in our contract when we make an offer, that the second one is, the seller is responsible for.
Sure. But the buyer's not going to pay for that one. That's actually in the guidelines for FHA. And I read these guidelines. If I have not seen something or done a specific loan in even a month, I will look at the specific guideline that fits that, because I don't know if it's changed.
Yeah.
Important actually before you list a house, and this is for the realtors, to know if the title's been dispositioned as real estate. Because I've had settlement agents say that if it's not, they won't do the title. I had some quit, and we're not doing double wides anymore because of that, so that if I had one that I had done the research and was disposed of as real estate properly, they would do it.
And there's is there a form from the DMV that you fill out for that?
There is a form, and what happens, it's usually got to be the original owner, otherwise it's like pulling teeth. Because again, it's a private record.
Mm-hmm.
You know, back in the old days, when I was at Wells Fargo, I could actually go in and they would give that to me, the actual form that should have been disposed of as real estate. Then they stopped doing that. So it's something that, since it's a private record, it's very important that you find the seller. I had one deal that took us 6 months to close because they couldn't find the original owner of the property to do that. It's a little easier now today due to COVID, but it still can be an issue. But before you list that house, if you wanted to go through smooth, make sure that you know that the property is dispositioned as real estate. And sometimes I think the current owner can go down there where they show that they had owned the double wide, they could do that, but they don't like third-party people going into that stuff.
Mm-hmm.
On that. You had mentioned something about skirting, since we're on the factor of manufactured home. I'll have people tell me that, oh yeah, the home is on a permanent foundation. Well, we're going to talk a little bit about that with loans as well. One, that's an exterior skirting.
Yes.
Double wides are put on a skirting. The lenders like brick or block, because vinyl can get cracked with a daggone weed eater, so they don't like that. So they like brick or block, stone, something like that, and it's not sitting on there. Actually, if you look at it generally, it might be touching it, but they put the double wide on its foundation, which are pillars, and then they have tie downs that tie. Those tie downs go into concrete, which are footers for the tie downs. So then they come around and put the perimeter skirting, which looks like a foundation, afterwards, because they pour the footing for that, and then they lay the brick and block in there. One of our renovation loans, if that's not done, can actually cover that. The skirting, because it's not structural.
So it'll take the skirting off and put brick or block around there.
It'll pay for that, right?
Okay.
On that sort of thing. Because
in North Carolina, they call that underpinning. Here they don't call it underpinning.
Right.
Which, it's interesting that it's just different, but here, if you say underpinning, they're thinking about the pillars underneath. But in North Carolina, I owned one there, and it didn't have skirting or anything. And I bought brick and put brick all the way around it, and the term was underpinning. Oh, you're underpinning it.
And that is true, because covering the different states,
Yeah.
and I hear that. It's like a differentiation. We call them tie-down straps in Virginia. When you go up to West Virginia, they call them hurricane straps. So it's just in terms of terminology. So you need to be aware. And the foundation, if you do an FHA loan, that foundation needs to be inspected by an engineer.
Oh, that's an extra expense.
It is, to make sure that, and that is typically a buyer expense, but they're going to make sure that it meets FHA standards. And they'll get up underneath it, they'll make sure the tie downs are properly, they'll make sure that the pillars are there. Some people think they have to be in shear wall, but they don't. And the reason shear wall would just make it look pretty, but the fact of the matter is if someone's going to blow it over, that shear wall is going to crack. But they make sure it's correct. And then they also look at any kind of decks or so forth that have been put on to make sure that that has not affected the structural integrity of the manufactured home. So that's going to be important with an FHA loan, always. So
what about if it's not an FHA loan, if you do some other type of loan?
Typically it doesn't have to be done.
Okay.
Right. Most people will want it on a USDA, because USDA is a unique loan. It's actually a conventional appraisal, but there's some FHA loans that you